freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, here with Adam Penn. Adam, how are you today?
Doing great. Excited for what we're going to talk about, and excited to be kicking about in the new year.
Yeah, absolutely. No, I'm excited about this one. I think this is a good, more practical type episode. So to kind of tee this up for everyone, we're going to walk through a deal, an apartment deal that we recently offered on. It was 100 and, I should know this, about 108 units. We offered $20 million. We got beat out by a family office that has a different profile of capital than we do, which we'll talk some about. But we just want to walk through this and walk through some of our assumptions, what we looked at, the sorts of things that went into to us from more sitting in the operator's seat to really trying to put a deal together, and then how that applied and sort of what we were thinking about from our passive investors from their point of view as we're assembling a deal that we felt would have been a really, really good investment opportunity.
Yeah. And just to kind of give a little bit of background on how we do some underwriting, what the spreadsheets are we look at, right? It's not some crazy complex software, right? It's just a spreadsheet that kind of walks through the numbers and lets us build some assumptions. Then when we do get into a best and final or actually under contract on something, it turns into a much larger due diligence and work with the property manager. But, we want it should be simple to analyze the deal, right? It shouldn't take 3 weeks to analyze an apartment deal. It should take you, your first pass. I think it takes us probably 15 minutes to say that we want to go any farther, and then probably a few hours if we really do want to dive into it.
Completely agree.
So this is a property we looked at in Henderson. The guidance was 25, but the numbers just did not make sense to us at that price range. So we came in at what made sense to us, which we kind of arrived at this $20 million purchase price after looking at where we thought rents were going to be, where we thought expenses were going to be. It was a little bit older building, 1990, so not horribly old, but old enough that nothing had been replaced really, and new enough that nothing needed to be replaced as of right now, but was going to have some higher CapEx going forward.
I'll make two high-level comments on this. Adam, you were talking about the spreadsheet and not needing a complicated model. I think there's a lot of folks in the finance world get hung up, especially when they see Google Sheets. That's obviously what we're using here, right? And they think Google Sheets isn't a real spreadsheet because Excel is the only way to do things. And I think maybe more of our tech-focused audience would probably disagree with that and knows that Google Sheets is quite powerful. But I think the bigger point here is you don't need some sort of ridiculously complicated financial model to perform this fairly detailed analysis, right? An analysis that is sufficient enough to make a decision about whether or not to offer, and then at what amount. I mean, I think we've got a couple tabs on this. There's one that's specifically designed for the loans, but overall, this is a single tab spreadsheet where we can have everything in one place that we can look at. Obviously, as Adam said, we will do deeper dives if an offer is actually accepted. But it's one of those things where you have to balance how much work you do before you actually have a deal that's in play. And I think if you've got people out there, especially other sponsors who are touting their incredibly sophisticated underwriting spreadsheet, I think to me that's a big red flag. There's not much alpha in the spreadsheet. The model for real estate is not that complicated. It doesn't take ridiculous long Excel macros in order to calculate all these crazy things, right? It's one of the reasons I love real estate, is because from the finance point of view, it's fairly simple. And so I think if you've, as a passive investor, if I ever see someone touting the sophistication of their spreadsheet or their underwriting model or something like that as a reason to invest with them, I think that's a pretty big red flag.
I had a very wealthy investor the other day tell me, I mean, he's been owning apartment buildings for, I think, over 60 years at this point. And he told me the other day, he was like, yeah, these models are cool, but over the years, my partner's always shown me things like this, and I always just punch some numbers on the back of a napkin on a little calculator I had in my pocket. And, 10 years later, our numbers were about the same. So
It's fun. So that's just a general warning to everyone that should be maybe a sign to ask some questions or potentially go another way if someone's talking about how for a real estate deal, how complex their underwriting is. It just does not need to be overcomplicated. And so I think that's one of the things we've built this. I think we're both, Adam and I are definitely both spreadsheet people, and I think we're happy with this. We've run it through several deals now, and we keep making tweaks, but it provides the data in a format that we need, and it's something that we can move through fairly quickly. As he said, we can make that first pass and make that decision as to whether or not it's something we want to dive further into. The other comment I'll make, this is not related to the spreadsheet, but Adam, you said we arrived at that $20 million number. That was a little bit of we backed into it in some ways. Well, I'm sure we'll go through this a little bit later. Obviously, we would have been happy with a smaller number, but from talking to the broker and just from some other things, we felt there was a psychological hurdle for the seller to see a 2 at the start of that number instead of a 1. And so we somewhat engineered our way back into that number to where we were comfortable that we were coming in on our own close enough to it that we felt like we could make the stretch to just further push our chances of closing that deal, or increasing the chances of actually getting a offer accepted simply if we had a 2 handle on it. And so that kind of gets to another thing where there's a balance. Obviously, you get very technical with the spreadsheets, the formulas, the things like that, but there's a human element to it as well. And we always have to keep that in mind when we're looking at these deals, that there's another human buyer, another human emotional buyer on the other, or seller on the other side of the table that we are negotiating with, and they don't necessarily care about what the formulas in the spreadsheet say.
Yeah. So we kind of built this just for, we took this actually from quite a few other ones that we've seen over the years and then added to it. And essentially this is a top-down analysis. So each box kind of represents its own space, but essentially we have our current rent. This is what's on the rent roll, right? What are they renting for? What's market rent? And then what are we targeting, right? If we're going to do a rehab or something like that, what are we going to be able to drive rents to? If they're an older vintage, this is what you normally see referred to in the multifamily space as a value add, right? You're coming in, you're adding value by maybe spending $10,000 a door, adding $200 a month of rent, and at a 6 cap, that's going to increase your value more than the money you put in, right? So I'm not going to dive through each individual number here, but essentially you can see at the top we have the rents. On the left over here we have all of our acquisition summaries. So what is our legal fees, what's our environmental, title, closing costs, escrow funds, principal escrowed from the lender, other things. We got things like travel down here at $1,000. This was in Vegas, and I normally fly Spirit down to Vegas, so it cost me a whopping $19 most of the time. But they've got like 5 flights a day. And then, what do the upgrades look like? And this is, $4,000 a unit on fixtures and another $3,000 a unit on appliances. And those are numbers we got from the property manager. The grounds are going to need a little bit of upgrading. And then, so we totaled in right around $1 million. And so then if we come down here and we look at what our down payment, rehab reserves, acquisition fee, everything, it comes into needing just under $10 million of equity. So from that standpoint, this is kind of what we look at. Okay, now we're going to have to go raise $10 million, right? That's the amount of equity we need. We're going to have to go get a loan for the rest of it. Our total acquisition cost, even though we're only paying $20 million for the building, is $22 million, right? Because there's rehab costs and all these other things that are getting added into this. And then over here on the right, we have this scenario, and this is kind of our first look at what does the math look like on a market cap of what the building's worth now versus what it might look like. And it's pretty simple. We're not getting on the left here. We get a little more complicated, but on the right, we're getting a little more generic. So I'll just start in the top left, and we just have our rent. It gives us obviously our gross potential rent when we multiply it by the number of units. We have some vacancy in here, so we're pulling this out of the vacancy they've actually had, the concessions, loss to lease, bad debt that they've had. And then they had some other income as well. So this would be washers and dryers, cable fee income, parking income, pet rent, any of those other items. A lot of the times, if I see a lot of late fees in there, I will back those out because that's not the tenant base we want, right? A few late fees, if it was $200 a year of late fees. I'm not going to worry about it. It's also really not going to change anything. But we looked at one building that was half of their other income was coming from late fees and lease terminations. And we're just like, well, that's just a horrible tenant base. We don't want to value the building based off of that income. We're hoping to get rid of those tenants and get higher quality, longer term tenants in there.
Yep. Adam, real quick, I realize we kind of neglect you mentioned this very quickly in passing a little while ago, but the overall business plan on this property was a value add type plan. And so we looked at the existing units. The existing ownership had renovated some. They were starting to see higher rents in those, and so that's a good sign. That's something that we want to see, obviously. But most of this property was unrenovated, really still in kind of the condition it was when it was constructed in the early 90s. And so, of course, because of that, rents were lower, and as compared to some of the newer properties and renovated units within the same property. And so there was kind of this plan or this path that had been proven that spending that money, that $1 million that we had down there between unit upgrades, grounds, things like that would produce higher rents, which of course pushes our NOI and pushes up the value of the building. So that's the high level business plan. Those are the kinds of things that we like. We talk about value add a lot because there's, again, we'll get into it as we go a little bit further down, but there's current cash flow that would exist on this, plus the ability to force the appreciation of the building and extract that at some point in the future. The other comment I wanted to make was you mentioned concessions and loss to lease, and just for anyone that's not terribly familiar with the space, that can be a number that we pull most of these numbers here from information that we've received from the brokers. So whether that's from the glossy backed magazine style offering memorandum or actual spreadsheet financials that they send us. But I think one of the things that's important anytime we see loss to lease is that really that number can be made up. So a lot of times if you would have to give an example of this, if the property or the owner or the property manager was saying that market rents were $1,000, but this unit was currently renting at $800, then there's a $200 loss to lease. But the reality is that top level number, they're just kind of making up. Whether or not market rents are actually $1,000 or are $1,500 or should be $700 is totally made up. And so we will look at that. We'll factor that in. We'll especially look at what they have on their actual financials. But it's something to remember that when factoring in loss to lease, that's a mostly made up number unless they can prove that other units should be leasing at that amount. But it's fairly common for us to see that where we'll see a $200 per unit loss to lease, but then we get the rent roll and there's not a single unit that's actually renting at that higher amount. So that's always something that when we go through these, we're looking out for. And then, of course, I mentioned, spent most of the time talking about loss to lease there. Concessions are just anything that the owner or the property manager are conceding in order to get people into the unit. So actually, when we were looking at this deal, I think they had was it first month half off or something like that? There was some, or first month free or something like that, or you signed up.
Yeah, but then when we went and walked the unit, they didn't offer it. You kind of had to ask for it, and I don't think they were offering it on the larger units. There was only ones they had like 2 available of. So
the concessions are definitely more real. It's the discounts or any other sort of incentives that the current ownership is giving to try to fill units. And so those are real, and obviously that's something that if there's a significant amount of those, that's a little bit of a red flag to us that, okay, maybe the rents that they're asking and that they're showing in the rent roll as the actual market rent is not very realistic.
So what we'll look at here is essentially, what does your gross income look like? Then we pull all their expenses from their actual expense list. And then that gives us their NOI, right? The net operating income, income minus expenses, excluding mortgage and insurance, or not insurance, just mortgage and taxes, right?
Would include a mortgage and entity level taxes.
Yep. And then what we'd end up with here would be, we'd see that it's roughly a 40% expense ratio, and then this 1.3 million over the purchase price we were willing to pay is about a 6.5 cap. capitalization rate. And then we can do the same thing over here on the right where we get a little more generic, right? Because we're projecting out into the future. Well, if we could raise rents to an average of $1,700, we would have a higher gross effective income. If we could keep expenses at 35%, this is the last time we played with it. I think when we were underwriting it, we were close to 40. We would be at a high 1.4 million of NOI, which is a higher cap rate.
Which is that's what we would want to see, right? Is like based on because the cap rate is simply the NOI divided by the purchase price. And so from our point of view, we want to see the cap rate based on our purchase price increase, because that means we've been able to increase NOI. When people talk about cap rates, there's market cap rate and then there's an actual properties cap rate. And so we will always look at on the first one there, which I think was it showing 6.6?
Mm-hmm.
That was roughly in line with the market. And so this at the time we were looking at this, the Henderson market for this quality of asset was somewhere in a 6, maybe down to 5.75, something like that. And so this showed us, it's like, okay, well, where we're underwriting based on the actual expenses and the actual income, we're pretty close to the price then that we would be paying is fairly close to the market cap rate. So there's all these levers that we're trying to pull and that we can pull, and it's one of those things that it's like, okay, are we super off here? Are we close to what the pricing guidance from the broker is? And that's just one of the things that we look at. But in this particular thing here, we definitely want to see an expansion of the cap rate, because that generally means we have increased cash flow. Because in this particular instance here, the purchase price obviously stays the same, but we've increased NOI.
Yep. And then down here, we'll probably skip over a few of these things, but this is just a quick debt cash flow summary, right? What does the cash flow after the debt service look like? If we have, $1.3 million of NOI and we're getting a $13 million loan, is it interest only? If it's not, what does it amortize at? What's the debt cost? And then what's our DSCR? This is just some high level. Does the loan make sense, right? If we're losing money after getting a loan every month, then that doesn't make sense. And then based off of a 6.5 cap in the market, what is the building worth? And so it's about $20.5 million, which is why we came in just over 20.
Yep. The other thing you mentioned, the DSCR there, and this one we were looking at an interest-only loan product on this, so it was fairly high. But that's another thing, right? It's not just that is the building cash flow positive, but realistically, we're not going to be able to get a loan if that debt service coverage ratio is below a 1.25. And so, which that's simply looking at, okay, what's the cash flow from the NOI, and then dividing that by the actual annual debt service. And so most lenders want that to be a minimum of 1.25 times. They want the debt service to be 1.25. Sorry, they want the cash flow to be 1.25 times what the debt service is.
Yep.
We talk about a lot of different formulas here, but that's an important one, and that's one of the reasons we have this little calculator here early in our spreadsheet. Is we need to make sure that based on what we know about market interest rates and the type of loan product for this type of asset that we could realistically get. Are we even in the ballpark here from a DSCR standpoint? Because that's almost always going to be if we can't meet a 1.25, it's almost always going to be a disqualifying factor for being able to get a loan on this.
Yep. Then moving down, we're just looking at essentially we always plan to do long-term hold, with our goal is to get investors most of their capital back after about 10 years. So we'll do that through a few different refis. And so this is just a little calculator we have where we're able to go through and look at what a refinance would look like in year one, or in year X and then year Y, right? So in this case here, we're looking at doing our first refinance would be in year 5. And then the second refinance would be in year 9. And we're basically looking at these numbers down here. What's the percentage of equity remaining, right? If we start with $9.8 million and we can do some form of cash out refinance, you can see most of the money that we're able to return is in this year 5 here, where it's $4 million of cash out. But if we could change this and move this to year 8, and it would break, obviously. So let's move that back to year 7. Oh, it's because the loan's too long. I could do year 6, and it would change, right? Otherwise, we'd have to have a longer term loan. We can't have the refi be after the term of the loan. And so this just gives us the opportunity to see what because our main game plan, like Dustin said, is a value add, increase the value, and then create cash flow for our investors, and then get them their money back over the long term. So what would that look like if we had to continue to refinance over a handful of years? So this just is a quick way to see, okay, can we even make that business plan play out based off of the assumptions we have? Then this is a little bit of what was before, right? So if we get into a full purchase agreement on this, signed purchase agreement, we're going to start building out budgets for every year. But in the beginning, we're going to start with what they have. We're going to change it a little bit based off of what our management company tells us of, okay, payroll needs to be a little higher or a little lower. The management fee is going to be this. We think their trash is too high. We can start playing with some of that. And we're just going to show what it is every year and then build a budget off of that. We show roughly a 3% rent escalation every year, so 3% rent growth, and a 2.5% expense growth. So there's a little bit of a gap there. We'll continue to see income grow over time. And then this is essentially where we just start playing with assumptions, right? If we think vacancy is going to be higher, we can up that to a 7%. And now, that's going to change the returns over time, right? It's going to take the cash on cash from where it was around 8 down to 7 here, 7.7. So just, we can, lots of little things to play with, but these are kind of some of our initial base assumptions. And then from there, we're able to go through, and we've got some more complicated stuff down here that, unless you want to, Dustin, I don't think we'll tear through all of it, because it just starts to show us what the cash flow looks like, right? What does the cash flow look like in a refinance, and what does it look like to an investor, and what are the splits? Right here, we were thinking it was going to be an 85-15 split. We could do an 80-20. What does that cash on cash to investors really look like for the long term here? And then, what does their capital account balance look like? Obviously, it goes down when we get a refinance. And then what does a hypothetical sale look like? What would the splits be to the investors? And down here, what does their IRR look like if we were to sell it? Things of that nature. So Dustin, out of that, is there anything else that you'd like to go over on this spreadsheet?
No, I think one of the funny things about this is the further down we go the spreadsheet, the further away from reality you kind of move, and the more you move into true assumptions, right? Mm-hmm. And I think if you scroll back up to maybe the financing section, I mean, it's tough. We don't know what interest rates are going to be 7 years from now, 10 years from now. So we try to make an educated guess at this, but the reality is these are some very powerful levers, right? I mean, if we drop that interest rate and we drop the market cap rate, all of a sudden some of these numbers look absolutely amazing.
Drop that to a 3 and drop your cap rate to a 4, and you get all your money back in year 5.
Yeah, and your year 10 IRR is now in the high teens, and that's even without pushing rents, right? And so that's another lever.
Yeah, change rent growth to 4%. And just continues to go, even if we keep the market cap at a 5.5.
Yep. And so that's one of the things where I think we always try to strike a balance between recognizing that there are some of these very powerful levers that we can pull that will make a big difference on the numbers, and recognizing that we don't have a crystal ball. We can't look into the future to know exactly what these things are going to be. We're going to try to make a educated guess. But realistically, these are assumptions. And so given that, we want to stay away from a lot of spreadsheet engineering of making these changes on here, making these assumptions appear, especially for the items that are completely out of our control, like interest rates. And market rent growth is, for the most part, out of our control. Yeah. So we don't want to choose some high number, even if we, in our heart of hearts, think that that's what's going to be. We stay on the more conservative side and choose something that we're like, okay, this is probably a middle of the road number that we're fairly likely to hit. And then we get more aggressive on the assumptions for things that we feel like we actually have control over. And especially so that, for things like rehab cost or what we think actual, market rent should be post rehab. Those are things that if we feel very, very confident based on comps and some other things that will hit those numbers, then yes, we'll get aggressive on that. But we're not going to sit here and assume that there's going to be 200 basis points of market cap rate compression over the next 5 years. So that's a thing where, from a passive investor point of view, if you're looking at investing in any kind of apartment deal, it's one thing to look at the high level numbers and you see the cash on cash and you see the IRR, but you have to understand what is going into those, because a 15% or a 20% IRR doesn't really tell you a whole lot. You have to know what is going into that and how much of that return is being produced off of things that are actually within the sponsor's control and things that are completely at the market's whims. And so that's always something, anytime looking at these, always make sure to dive into these assumptions. You want to see things like this. Like, one of the things that drives me nuts, we've talked before about, we like the Vegas market because it's supply constrained. There's not been a lot of new construction there. And so we realistically think rents are going to grow, at least in probably sometime around year 3 to 5, are going to be growing at more than 3%. But we're also not going to model that, just in case it doesn't come true, or there's other factors, again, outside of our control, because while we're setting ourselves up for success by investing in a market that is positioned to see outsized rent growth, that's still ultimately outside of our control. And so we're not going to take aggressive assumptions, even though it'll make the numbers look great, in order to remain fairly conservative. And so what we want to do is bring a good, solid deal to our investors, knowing that these are middle-of-the-road assumptions. It's a good deal. And then if these handful of things that we honestly do believe will occur, if those do happen, then all of a sudden this becomes a really, really great deal for our investors. But we're also not going to lead with those numbers and lead with all the things where, okay, in order to hit these numbers, every single thing has to go exactly right. The deal has to be, it has to be executed to perfection. All of these things where if you got one little thing that doesn't work, then now it's underperforming or even worse. So that's we can go down further in this spreadsheet, and a lot of this is really just designed for us to arrive at some of those high level numbers there. There's a lot of math that goes into that, but it's important. And again, for us, it's important to recognize what those levers are that can move those numbers, and which one of those we can actually pull and which ones are going to be pulled by the market for us.
Yep. I'll share one story before we close this out, which is, I was on a call with an investor one time, and they said, well, I'm looking at your deal, I'm looking at another deal, and the other deal has a higher IRR. And I said, well, I can make mine show a higher IRR. And they were like, what do you mean? And I was like, well, all we have to do is change this number or that number. These are just assumptions on a piece of paper. Like, which business model do you believe more? Which one do you think can execute on the business plan more, and the returns are more likely based off the market or the assumptions they've made, right? Just as we showed you, we could make this thing look like a killer deal by changing one number on the spreadsheet, right? You just have to change the market rate compression and be like, well, it happened before, it happened during COVID, right? Prices went way down, or cap rates went way down, prices skyrocketed, interest rates went down, Trump's coming back into office. Like, all of this is going to happen again, right? It's perfect. But that's not a realistic way to underwrite a building or to bet hard-earned money on.
No, this is great. And obviously we can spend hours going into detail on some of these things and talking through some more in detail, but that's a very high level view for how we approach underwriting just an example deal. The way that we think through things, obviously the assumptions, the numbers, some different things. Every deal is different, but we at least think this was a good way to show how we approach things. And then also from a passive investing standpoint, the things, whether it's our deals, whether it's someone else's deals, the things that you've got to be looking into and looking beneath that, those high level numbers that are going to lead on the pitch deck. I don't know. Anything else, Adam?
Nothing for me. Thanks everyone for watching. If you got questions, feel free to reach out to us. Go to our website, schedule a call with either one of us. Happy to dive through these. If you've got a deal that you want to share with us and get our opinion on, happy to do so. And we've got deals too. So if anyone's looking, feel free to give us a call.
All right. Thanks, Adam. And thanks everybody. And remember, where freedom leads, where wealth follows. Thanks so much.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.